Ladies and gentlemen, Asian guy here again. While you were scrolling through X watching people panic about a bank collapse, the real heist was happening in a place so boring that nobody was paying attention. A CME notice, a margin adjustment, $3,000 per contract. If those words make your eyes glaze over, you just missed the greatest sleight of hand in silver market history. Because on December 29th, 2025, while finance Twitter was losing its mind over a viral screenshot claiming that a major U.S. bank got liquidated on silver futures at 2:47 in the morning, the actual story, the one that cost traders an estimated $675 million in a single day, was buried in regulatory paperwork that nobody reads. The price you saw collapse from $83 to $70. That brutal 11% intraday massacre that looked like the end of the silver rally wasn't caused by fundamentals. It wasn't caused by a supply glut. It wasn't even caused by the mythical bank blowup that went viral. It was caused by three little words that appear in a CME bulletin: margin requirements increased. Now, to someone who doesn't trade futures, that sounds like accounting noise. But to the 224,167 traders holding open silver contracts when that notice hit, those three words translated into an immediate demand for $675 million in fresh collateral. Not tomorrow, not next week, immediately. And when you tell a market that is already sitting on 15-to-1 leverage that they need to post 13.6% more cash right now or get liquidated, you don't get an orderly retreat. You get a stampede for the exits. You get a mechanical execution that looks like panic, but is actually just math with blood on it. So let me be very clear about what happened. There was no bank failure. There was no 2:47 a.m. liquidation of a systemically important institution. There is no CME default notice. There is no Federal Reserve emergency intervention. What actually occurred is far more insidious, far more revealing about how fragile this market is, and far more bullish for anyone who understands that forced selling is not the same thing as voluntary selling. The crash you witnessed was a margin-induced deleveraging event disguised as a crisis. And the entity that pulled the trigger wasn't a bank. It was the exchange itself. But to understand how they engineered this wipeout, how they extracted $750 million from the silver market in a single session, we have to start with the mechanics. We have to look at what a margin requirement actually is and why a $3,000 increase per contract turns into a bloodbath. Because this isn't just a silver story. This is a blueprint for how exchanges control price, flush out leverage, and protect the shorts from getting squeezed into oblivion. And if you trade with leverage in any market, crypto, futures, options, you need to understand this playbook because they will run it on you too. Think of margin as the security deposit on an apartment. The landlord, in this case the Chicago Mercantile Exchange, wants collateral to protect themselves in case you wreck the place. In futures trading, wrecking the place means the trade moves violently against you and you can't pay your losses. So the exchange demands that you keep a minimum amount of cash in your account as insurance. For silver, that number was sitting at roughly $22,000 per contract. One contract controls 5,000 ounces of silver. At $75 per ounce, that is $375,000 worth of metal backed by a $22,000 deposit. You are controlling 15 times more value than you put down. That is 15x leverage. Now imagine you're running a trading desk. You have 100 silver contracts. Your total notional exposure is $37.5 million, but your cash outlay is only $2.2 million. You're printing money as silver rips from $30 to $83. Life is good. Then on December 26th, you receive a notice from the CME. Effective December 29th, the margin requirement is increasing from $22,000 to $25,000. That is a $3,000 jump per contract. For your 100 contract position, you now need an additional $300,000 in cash sitting in your account by Monday morning, or your broker will start closing your positions. You have three choices. Choice A, wire the $300,000 and hold your position. Choice B, reduce your position size by selling contracts to free up margin. Choice C, do nothing and let the broker liquidate you at whatever price they can get. Most traders, especially the ones who are already maxed out on leverage, don't have $300,000 sitting in cash. They were already all in. So they are forced into choice B or choice C. They become mechanical sellers. They don't care about the fundamentals. They don't care that silver is in a structural deficit. They don't care about China's export ban. They need to reduce their exposure to match the new margin rules, or they cease to exist as traders. Scale this across the entire market. According to the latest data from the Commodity Futures Trading Commission, there were approximately 224,867 open silver contracts as of the most recent reporting period. Multiply that by the $3,000 margin increase. You get $674.6 million. That is the amount of additional collateral that the silver market had to produce in roughly 72 hours. $750 million in fresh cash injected into margin accounts, or the positions get liquidated. Do you see the trap now? The CME didn't just raise margin because they were worried about volatility. They raised margin to force volatility. They created the conditions for a liquidation cascade. And right on cue, the cascade arrived. Silver, which had been trading near $83 on Friday, opened on Monday and immediately started bleeding. By the time the dust settled, the price had crashed through 80, through 75, and bottomed out around $70 before stabilizing near $72, an 11% intraday wipeout, the kind of move that wipes out entire accounts, the kind of move that makes people believe the rally is over. But here is what the chart doesn't show you. The chart doesn't show you the $675 million margin call sitting behind the candles. The chart doesn't show you the thousands of traders who didn't want to sell but had no choice. The selling pressure wasn't organic. It was manufactured by a rule change in the middle of a squeeze. This is the invisible hand of the exchange. They have the power to change the rules of the game at any time. And they always change the rules when the shorts are in trouble. Because here's the uncomfortable truth that nobody wants to say out loud. The CME is not a neutral referee. The clearing members of the CME, the big banks and brokers who guarantee the trades, are the very entities that are short silver. When silver was ripping from $70 to $83, those shorts were bleeding. Their losses were mounting. Their risk managers were screaming. So what does the exchange do? They raise margin requirements. They force the longs to post more cash, knowing that most of them can't. They engineer a sell-off to relieve the pressure on the shorts. It is a bailout disguised as risk management. But the brilliance of this operation, the part that makes it so hard to fight, is that they don't have to announce it as a conspiracy. They just cite volatility. They say, look, silver moved 15% in a week. We have to protect the integrity of the market. It sounds reasonable, it sounds prudent, but the timing is always the same. Margin hikes come when the price is spiking against the shorts, never when it's collapsing in their favor. The asymmetry is the tell. It reveals whose side the exchange is on. So when you see that 11% crash and you hear people on X screaming about a bank failure, understand what actually happened. The bank didn't blow up. The overleveraged longs got margin called into oblivion by a rule change that was designed to protect the overleveraged shorts. The irony is suffocating. The system claims to be managing risk, but all they did was transfer the risk from the institutions to the retail traders. The banks got saved, the speculators got slaughtered. But here is where the story gets even darker. While this mechanical liquidation was shredding the paper market in New York, the physical market in the East was completely ignoring it. Because the thing about a margin-induced sell-off is that it only affects the paper. It only affects the people who are trading contracts, IOUs, claims on silver they will never touch. The people who actually need the metal, the industrial users, the Eastern buyers, the stackers, they looked at the $70 price tag and started backing up the truck. The divergence between the paper price and the physical reality just widened to a level that proves the crash was fake. Let me show you the numbers that the mainstream financial media is desperately trying to ignore. While New York was painting red candles and traders were panic selling into the margin call, the Shanghai Futures Exchange closed its silver contract at a price that, when you do the currency conversion, works out to approximately $85 per ounce. Let me say that again. New York is trading at $72. Shanghai is trading at $85. That is a $13 spread. That is an 18% premium for physical silver in the East, while the paper silver in the West is supposedly crashing. In a normal market, this spread would last about 10 seconds. Arbitrage traders would instantly buy silver in New York at $72, ship it to Shanghai, sell it for $85, and pocket the $13 risk-free profit. That arbitrage mechanism is supposed to keep global prices aligned. It is the economic law of one price. But the arbitrage isn't happening. The spread is sitting there wide open, mocking the entire concept of a unified market. Why? Because the physical metal can't flow. The China export license restrictions that went into effect on January 1st have built a wall around the Eastern market. The silver that is in Shanghai stays in Shanghai. The silver that is in New York stays in New York. The two markets have completely decoupled. This $13 premium is not a blip. It is not a temporary dislocation. It is the market screaming at the top of its lungs that the paper price is a lie. If silver was truly in oversupply, if the rally was truly over, the price in Shanghai would be crashing too. But it isn't. It is holding firm near $85 because the physical buyers in the East know something that the paper speculators in the West don't. They know that the metal is scarce. They know that the vaults are draining. They know that this margin-induced sell-off is a gift, a temporary window to buy real silver at a paper discount before the system breaks completely. And we have the vault data to prove it. In the days leading up to the margin hike, the registered silver inventory at the COMEX, the metal that is actually available for delivery has been hemorrhaging. Over 600,000 ounces were withdrawn in a single week. The total registered inventory now sits at approximately 30 million ounces. That sounds like a lot until you realize that the open interest in silver futures represents claims on over 1.1 billion ounces. The ratio of paper claims to physical metal is insane, and every time the price gets smashed by a margin call, the physical stackers remove more metal from the system. They are draining the vaults while the price is artificially suppressed. This is the behavior of buyers who know the game is rigged. They are not panicking, they are not selling, they are using the paper manipulation to accumulate physical metal at a discount to the real price. And when the physical inventory finally runs dry, when the COMEX can no longer deliver against the contracts, the paper price will have to snap up to meet the physical price. That 13-hour gap will close, but it won't close by Shanghai, dropping to $72. It will close by New York, gapping up to $85 overnight, and everyone who sold their position into the margin call will realize they got played. But the media doesn't want you to see this. Turn on CNBC, read the headlines on Bloomberg. What story are they pushing? They are telling you that the silver rally is over. They are saying that retail investors are panic selling. They are blaming the crash on profit-taking and momentum traders bailing out. It's a narrative designed to make you sell. It is a psychological operation. The actual flow data tells the opposite story. We have access to the inflows and outflows from the major silver ETFs, the vehicles that retail investors use to gain exposure to silver without holding the physical metal. During the crash, when the price was plunging from $83 to $70, what did retail investors do? They bought. The inflows into SLV and PSLV spiked. The little guy saw the dip and added to their position. Meanwhile, the online bullion dealers are reporting record traffic. The volume of orders for physical silver coins and bars is running at 3 times the normal rate. And the vast majority of that volume is on the buy side, not the sell side. So if retail didn't sell, who did? The answer is obvious. The over-leveraged institutional players who got caught in the margin squeeze, the hedge funds running 15x leverage who couldn't post the extra $3,000 per contract, the algorithmic trading desks who were forced to cut their positions to meet risk limits. The selling came from entities that had no choice. It was mechanical. It was forced. It was not a vote of no confidence in silver. It was a liquidation event in a casino that suddenly changed the betting limits in the middle of the hand. And the media is lying to you about this because they need a scapegoat. They cannot admit that the system is fragile. They cannot admit that a single margin adjustment can cause a $675 million wealth transfer. If they told you the truth, that the exchange itself engineered this sell-off to protect the shorts, it would cause a crisis of confidence. People would stop trusting the futures market. They would pull their money. The whole derivatives complex would be exposed as the Ponzi scheme it is. So instead, they blame you. They say the retail investor panicked. They gaslight you into doubting your own conviction. It is sickening. But here's the beautiful irony. By blaming retail for selling, they are accidentally telling you the truth about who is actually accumulating. If retail was selling, the premiums on physical silver would collapse. Dealers would be flooded with inventory. But the opposite is happening. Premiums are spiking. Delivery times are stretching to 6 weeks. The supply is tighter than ever. The only conclusion is that someone very large is buying the dip, and that someone is not a retail stacker. That someone is an institution that understands exactly what this margin hike was designed to do. They are using the forced liquidation to scoop up physical silver at artificially suppressed prices. This brings us to the deeper, more strategic question. Why now? Why did the CME raise margin requirements on December 26th, effective December 29th, right in the middle of the holiday period when liquidity is already thin? The timing is surgical. Most traders are on vacation. The order books are shallow. The bid stack that normally absorbs selling pressure is paper thin. By implementing the margin hike during Ghost Week, the week between Christmas and New Year when nobody is paying attention, they maximized the chaos. They ensured that the liquidation would be violent. They turned a $3,000 rule change into an 11% price crash. And they did it right before China's export license system goes into full effect on January 1st. Think about the setup. China is about to lock the gates on silver exports. The Western world is about to lose access to the largest refining hub on the planet. The supply shortage is about to go from structural to acute. The industrial buyers are about to panic. And right before that panic hits, the CME engineers a crash that shakes out all the weak hands. They clear the leverage. They force the speculators to sell. And when the new year arrives and the industrial bid hits the market, the only entities left holding massive positions are the institutions that had the capital to weather the margin storm. This is textbook market manipulation. It is a coordinated effort to transfer wealth from the leveraged speculators to the patient accumulators. The exchanges, the banks, and the regulators are all in on it. They use the rules to engineer volatility. They use the volatility to justify rule changes. They use the rule changes to liquidate their opponents. It is a closed loop of control, and the only way to beat it is to refuse to play their game. You beat it by holding physical metal. You beat it by ignoring the paper price. You beat it by understanding that every forced sell-off is an opportunity to buy real assets at fake prices. So what happens next? We are now sitting in the aftermath of a $675 million margin squeeze. The weak hands have been flushed out, the leverage has been reduced, the market structure is cleaner than it has been in months, and we are 48 hours away from the China export ban going live. When the institutional desks return from vacation on January 2nd, they're going to walk into their offices and see a market that just crashed 11% on forced selling. They are going to see a $13 arbitrage gap between New York and Shanghai. They're going to see COMEX inventories at multi-year lows, and they are going to realize that the crash was a gift. The buying pressure that hits this market next week is going to be for jobs. Industrial users who need silver to keep their production lines running cannot afford to wait. They saw what happened when the price spiked to $83. They saw the margin calls, they saw the chaos, and now they see a $72 entry point that might not exist in 72 hours. They are going to rush to secure supply before the China ban fully chokes off the flow. They are going to bid the price back up, not because they are speculators, but because they are desperate. And when desperate buyers with unlimited capital enter a market with limited supply, the price doesn't drift higher. The gaps, I'm calling it right now. By the time we hit January 10th, silver will be back above $80. The $70 low will be remembered as the greatest bear trap of 2025. The traders who panicked sold into the margin call will watch in horror as the price recovers and then exceeds the previous high. And the institutions that engineered this crash, the ones who forced the liquidation and then bought the blood, will have successfully executed one of the most profitable trades in commodity history. They used the rules to steal your position, they used the media to convince you it was your fault, and they used the physical shortage to guarantee that the price would recover. But here's the part that should make you furious and then bullish. The $675 million margin call proves exactly how fragile the paper market is. It proves that the system is held together by collateral requirements and regulatory duct tape. It proves that a single rule change can cause a double-digit crash in a market that is supposedly deep and liquid. This is not strength. This is brittleness. This is a system on the edge of collapse. And the more they have to intervene, the more they have to raise margins and engineer sell-offs, the closer we get to the moment when the intervention fails completely. Because you cannot margin call physical metal. You cannot liquidate a coin sitting in a safe. You cannot force a vault to sell its inventory just because the paper price moved. The physical market is immune to the games that the futures market plays. And as more investors wake up to this reality, as more capital flows from paper to physical, the disconnect we are seeing today becomes permanent. The paper price becomes irrelevant. The physical price becomes the only price that matters. And when that happens, when the majority of silver demand shifts to physical, the futures market loses its power to suppress. The price discovery mechanism moves from New York to Shanghai. The West loses control. This is the endgame that the CME is desperately trying to delay. Every margin hike, every forced liquidation, every manufactured crash is an attempt to extend the life of the paper market. They are buying time. They are hoping that the industrial buyers will accept the paper price. They are hoping that the physical shortage can be papered over with more contracts and more leverage. But hope is not a strategy. Math is math. Geology is geology. You cannot print silver. You cannot rehypothecate atoms. And when the vaults run dry, the game is over. So here's your marching order. If you sold into the crash, if you panic, sold your position because you believed the viral rumor about a bank blow up, you need to understand that you were the victim of a coordinated attack. The bank didn't blow up. You did. You let the margin hike scare you out of a position that you should have been adding to. The crash was not the end of the rally. It was the shakeout before the next leg. And if you want to be on the right side of this trade, you need to stop trading paper and start holding physical. The institutions that engineered this crash are not selling their silver. They are accumulating it. They are using every dip, every margin-induced sell-off, every manufactured crisis to transfer wealth from the impatient to the patient. The only question is which side of that transfer you want to be on. Do you want to be the trader who sold at $70 because the exchange changed a number in a margin table? Or do you want to be the holder who bought at $70 knowing that the real price is $85 and climbing? The $675 million margin trap was not a bug. It was a feature. It was designed to test your conviction. It was designed to separate the speculators from the investors. It was designed to flush out the weak hands before the real move begins. And if you understand that, if you see through the manipulation and recognize the opportunity, then this crash is not a disaster. It is the last cheap entry point you're going to get before silver reprices to reality. Hold the line. Ignore the noise. Watch the vault strain. The paper game is dying. The physical reality is taking over. And the price is about to reflect the truth that the CME tried so hard to hide. Silver is not crashing. Silver is being suppressed by mechanical liquidation so the giants can load their boats before the supply runs out. They got their $675 million. Now they want your ounces. Do not give them the satisfaction. I am Asian Guy from the AG Finance. Like, subscribe, And share this with everyone who needs to understand that the crash was a lie and the squeeze is just beginning.